taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to the Total Money Management Podcast. We're going to be going through the week that was August 12 to 16. How was that, Steve?
Excellent, Tom.
Nailed it.
All right,
Excellent.
Good.
No feedback.
I've done it. All right, perfect. All right, August 12 to 16. What we're going to be talking about today, let the games begin, furniture as a canary, waning wages, rate hawks, rate cuts really, and following rate cuts.
You just get more and more creative with these, Steve, don't you?
Mate,
He ran out of ideas.
I'm an innovator.
He was halfway through a bottle of red and went,
Furniture as a canary. Do you know what that means?
No.
I do.
You do, Tom?
Yep, I read the article.
Elaborate.
Nick Scully, but we're not there yet.
No, I'm not talking about Nick Scully. I'm talking about, oh, God, you young people. Seriously.
Okay.
As a canary. The old saying is it's a canary in the coal mine.
No, I do get that.
Right.
And declining furniture sales indicate that people are holding on to their money a little tighter.
Bingo.
There you
right,
go.
see?
Joining dots.
You're pretty
Mate,
smart.
I learn slowly.
He's not
but
just a
surely.
pretty face, that boy.
Come on now.
Right, what have we got, lads? What have we got?
The big issue being the games are over now, so we've got to find something else to talk about. The
War.
real games are only just beginning.
Absolutely. Let's talk about war.
Well, things start to be heating up, right? In Israel and Iran, and then Russia, Ukraine. Saw an article that the US is sending more military resources to the Gulf.
Yep. There's a lot of war going on. China and the Philippines are having a brouhaha in the waterways over there about fishing and, stepping on each other's territory and stuff. And it's quite aggressive. And then you've got, when you look at the Middle East, I did it in the masterclass on, when did we do that, gents? Tuesday night.
Yeah.
Which was Tuesday, August the 20th. Thank you.
That was take two.
That was take two.
Oh.
Yes, thank you. Moving right along. The list there, when you look, you've got Russia, Ukraine, you've got the Middle East, you've got the Red Sea. There's stuff going on in Libya. There's stuff going on in Syria. There's a lot of aggro out in the world at the moment. And that's, for investors, that's what you got to watch fairly carefully, because one of those events goes, haywire or something, and you get a $10 increase in the oil price, right? Or the market panics, and we get a sell off like we've had recently, and those sorts of events.
Well, speaking about the sell-off, it seems to basically do a V-shaped recovery over in the US. Sold off due to the Japanese yen issue.
Carry trade.
Yeah, the carry trade issue. And then the preceding week just V-shaped.
Yeah, but it's not unusual, because remember we talked about volatility. And again, it's really important to, like we were just talking before, about you've got to understand how the market operates, because the thing that freaks you out is the unexpected event. Now, there's two ways that can happen. It can happen on a personal level where you get the sack, right? And you go, man, that was unexpected, right? And that's when you go, okay, I really got to hunker down. I'm going to sell all my shares because I need the cash flow or something. The second one is a systemic event that's unexpected. So in other words, like I said, someone bombs Saudi Arabia and the oil price goes from $80 to 120 overnight, right? That impacts everybody freaks out, and we get general chaos. What you find with most volatility is that it goes down a lot, but it also bounces a lot in a short space of time. So like you said, Jacob, it went down like 10%, and now, here we are, August the 24th or something, and it's back to where it was, right? Australia has had 10 straight up days, right? Now, that's really, really rare, right? So that's the thing that freaks you out when it's going down, and you think, oh man, this is terrible, I got to sell some stuff, without realising that volatility clusters and the big up days are next to the big down days. And that's really important to know, because that helps you go, okay, that's cool, I'm under control, I got cash, yeah, it doesn't feel real good, but that's fine, I know the way it works, and it just helps you calm those emotions. And that's the really important part of investing. You've got to get a handle on your emotions. And the way we teach it is by saying, here's a big bunch of knowledge. So when the market does get volatile, you go, okay, I'm just going to use the rational part of my brain and not freak out and go through the approach. Okay, I've got cash. Yep. Okay, cool. I'm investing for 10 years. Okay, that's all right. That's no problem. I've got ETFs, not, junior mining specky companies. Okay, well, that's good. In fact, it's an opportunity. Oh, I might put some more money in the market, actually. That's the whole idea.
Yeah, while fear's driving the market, you want to be sat on the sidelines going, okay, I've got a strategy that works.
Well, yeah, or indeed, this is not financial advice, but, yesterday I bought a company that fell 21% in the Australian market. So, and it's not going to be financial advice because I'm not going to tell you which one it is. But my point being, most people look at that and go, oh, man. I look at it and go, oh, hello, this looks all right. I'm going to go and have a look at this. Then I knew the company anyway, and so I bought some. Right?
Do you have a decent dividend?
Not too bad, about 5.5.
Oh, yeah, that's good.
What's the PE?
At the moment, now very low.
What's the sector?
Because the sector is...
Just digging now. You're going to go buy some, Tom?
Yeah, food wholesaling.
What's the ticker on the ASX?
That's probably a bit too much. Yeah. Moving on.
Yeah. Chicken. There's your hint. That's it. Go look at that.
But let's talk about China's slowdown again briefly. It's looking like they're having a bad time in the housing market. What commercial property is down 20%?
Well, yeah, all property is starting to fall. I think I mentioned in this week's, which is August 19 to 23, this week's video, that China is really starting to, in my mind and from my experience with Japan, China is really starting to roll over. Like the property market's starting to roll over. They've got problems in the steel sector, and they've got the same thing that Japan had, which was this massive manufacturing capability and capacity, which is when the market falls is a real problem. And I think we discussed it last week where we said, they can build 45 million cars, but the local market's about 20 million. So in other words, they're exporting heaps of cars. But when the Americans and the Europeans go, listen, we don't want those cars.
Yeah, tariffs.
The problem is for China going, hey, dude, what are we going to do with these 10,000 people who they're making all these cars, but nobody's buying the cars, right? And this is exactly what happened to Japan. And it's that model of economic development where they export, right? But the problem is America has always said, yeah, right, we'll take them. We'll take them. Now the Americans say, nah, we're not taking them anymore. We're going to do our own stuff. And that becomes a real problem.
Well, that's not just affecting China. It's Japan, it's Germany.
That's right, the big manufacturers, right? Because that's what they've done. They've taken over the manufacturing that Australia, England, Canada, New Zealand and Australia and the US used to do. See, we went, we can get cheap cars from China. Oh, well, we don't need to build any. But we're not the United States.
Yeah, we can make more money that way.
Well,
without thinking about the risk.
Yeah, it's this economic theory of comparative advantage. You got lots of iron ore and coal, we'll just dig up that stuff. We got lots of people, we'll make the cars. You sell us the iron ore and the coal, we'll make them into cars and sell them back to you. Hey, cool. You win and we win. But the problem is when someone says, oh, actually, I'm going to game the system a bit, that's when you get a problem. And that's what it's called mercantilism, which is what Germany, Japan and China have been doing. So instead of China saying, no, we'll let you compete on a level playing field here, like the United States, China says, no, we don't want any of your stuff, but we want you to buy all our stuff. And so what they do is they keep interest rates low, so businesses have got cheap capital. They keep the exchange rate low, so that reduces imports and it increases exports. Right? That's the way they do it. But there comes a point, and we're at that point where the buyers, the US says, listen, guys, we're not putting up with this anymore.
Well, it's going to take significant investment from the country. So the US, we know, have started to do it, but Australia really doesn't build anything anymore. They just export their resources. Yeah. So it's going to take significant investment from we'll use Australia as an example, to start building these plants again, start building the manufacturing businesses. Like if we want to start remaking cars, like it wasn't so long ago we said we're not making Holdens anymore.
Yeah.
Is it going to get to a point in the next 5 or 10 years where we say, oh, we are going to make Holdens again now?
No, I think Albo came out a few months ago with an industry policy, right, which was, I think, Future Australia, Future Made in Australia or something. So what they're doing is, and this is the way we're going now because of the Cold War, right? Well, people won't say it's the Cold War. I'm calling it the Cold War, which is the US versus China. And so what we're doing this week, Australia said, we're going to make our own missiles. Right, so now we're in the missile business, gents. So the point being, we probably won't make cars, but what we'll do is we'll have a free trade agreement or some agreement with Thailand because they make a bucket load of cars.
Yeah,
and Thailand will say, all right, well, if you're going to buy our cars, we're going to buy your iron ore, right, or we're going to buy your coal or something like that. So what I see happening is, and the US is driving this. The US is basically saying, listen, you guys have got lots of lithium and iron ore and rare earth minerals and all that sort of stuff. Listen, you just dig that stuff out of the ground, right? You send it to Thailand, right? Listen, you guys make the cars, righto? Over here in America, we'll design the semiconductors and we'll all be integrated that way. So it's just a reconfiguration.
Carving out China, you're carving out.
Exactly, Russia and saying... Yeah. The American Department of Defence gave Lynas, an Australian rare earths producer in Malaysia. They have a mine in WA and they send it to Malaysia where they process it, right? It's a really ugly, really heavy toxic process. So the American Department of Defence said, all right, well, we'll give Lynas $100 million to help build a heavy rare earths facility, right? Well, why would America give an Australian company money? Simple, right? Because you need them for bombs and bullets and all that sort of stuff.
Friendshoring.
That's exactly right. And the Americans are saying, listen, we'll give you the money, right? But here's what you guys are going to do. And that's the way it's working out, right? We'll do this bit, you do that bit, you do that bit. Okay, all right, cool. Nobody's going to be buying EVs from China. Got it? And it's like, got it. Because as I said, I think last week, the data is the important part.
Yeah.
Right?
Well, moving on to Monday, we can probably conclude now that the tax cuts are not going to add economic growth to the economy, which we've been saying, Steve, you've been saying for a long time now, but no one's spending their cash.
I don't think so.
So
I think it's just, my observation is it's just ticking along. We're not really growing that much.
It's like we've said, I think we probably say it every episode. It feels like the vast majority are just hanging in there. Right?
I think so, yeah.
But there's obviously certain markets and things like, some property is sitting on the market for a lot longer, probably in that first home buyer's price point. Whereas, the $2, $3, $4 million properties, they seem to still be, plenty of people at the auctions. They're turning over really quickly. So, yeah.
You're looking at $2 million properties, mate?
No. Definitely not.
Give it a week.
Friends of friends, yeah.
give it a month. If you're in Sydney, the median price is already $1.8 million.
Well, I saw yesterday, it's now, Sydney's the most expensive place to buy a house in the English-speaking world.
That'd be right.
Which is, yeah.
So you think about that, the median house price is $1.8 million. I mean, it's just batshit crazy. I mean, it's just, seriously, Brisbane's at 960.
Yep.
Average, right? Like, you just look at that and go, oh, please.
Buy a matchbox.
Mate, it can only go up, okay? So.
Apparently so. That's what people on Instagram who absolutely have spent years in markets have told me.
I've been talking to property guys, I think I mentioned to you both yesterday. They're like, that Steve guy just hates property, doesn't he?
And I
was like, no, he doesn't hate property. We need to find yield. If we're relying on capital gain, then...
Well, I say this every week. I don't hate property. But if you offer me a property that's wildly overpriced, well,
if you offer you anything that's wildly overpriced, you're going to
property or Doritos.
No one ever says... no one says, oh, that bloody Steve hates Nvidia. And it's like, I don't hate it. I'm just telling you, on a PE of 80, it's not really a great investment.
Yeah.
That's all I'm saying. I don't hate property. I've had property. I've made money from property. I don't hate it. I'm just saying it's, we're closer to the top of the cycle than people realise, and it's a really dangerous way to invest. Yeah. But if you want to do it, hey, no problem. I don't let my emotions get involved in going, oh, I love that house. Oh, it's 500,000 more. Oh, well, I'll just buy it. Which is what one of my ex-relatives did.
Ex-relatives.
Moving right along to Tuesday.
Yeah, well, wages growth was hailed a success in most headlines, but it's looked at in relation to inflation, getting those two words right. And over the long term, real wages are falling. So I mean, it goes to what you were saying before, Tom. It feels like people were getting paid more 20 years ago, although they were getting paid less, if that makes sense, because everything else was less to buy.
Relative terms, yeah.
And if you look at the numbers, technically there's been wage growth. But the point really on the Tuesday segment, right, is that, well, if you look at real growth, not at all.
There we go. We got a picture.
Okay, sorry, you just threw me off.
Sorry, mate. Get yourself back on track. You right? All right? Okay, take a deep breath.
Not really.
Okay. You want me to take over for you?
Yes,
okay,
please.
all right. We'll send you, what do they call that room? Safe room
care
or something?
package.
Yeah. Trigger room or something. Have you been triggered?
Where's the safe word?
Righto, the idea is, there's bugger all wages growth. It's been bloody well 15 years. You poor bastards out there have hardly got any money. And so you've had to leverage up in property to try and get ahead. There you go, and there's a picture. And the picture says, look at that shitty wages growth.
I didn't think it had been 15 years since there'd been a proper growth.
It's been, I think now, this, you can take this for whatever you want. As when the Liberals came in about 2013, I think, or 14, wages haven't gone up since. And we've actually indeed going to talk about that next week.
Well, it's saying year on year it's gone up 3%, right? But that's not really true because of inflation.
That's right.
Yeah.
That's right. That's why, when Albo and Chalmers are out there going, oh, yeah, we're raising wages and stuff, and we've got inflation under control, well, people are still going backwards. Yeah. Now, part of that problem is the debt that people have got, and they need to acknowledge that, if you've got 2 or 3 investment properties and your $1,000 disposable is now $150, well, that's on you.
It's your problem.
Well, yeah, partially. I'm a little bit more sympathetic there because I think people are just trying to achieve their financial goals, right? And the problem we've got, Tom, is that if you're not getting enough in wages, you instinctively go, man, I got to do more here. Right, because we're not, we're both on 80 grand, but we've got 2 kids and we've got everybody's in bloody private school and private health cover, and it's how come we aren't making any money? That's when you say, hey, the bank will lend us $1 million. We should buy an investment property. They're not being greedy. They're just simply saying, well, how do we get ahead? I was thinking just this morning, when I was a kid, now I'm one of 5, and when I was a kid, my father worked, my mother never worked, right? We lived in a 3-bedroom place. We had a sort of modest lifestyle. But these days, you need 2 children, you need 2 parents working. God forbid if you had 5 bloody kids, you wouldn't be able to afford it. Now people can't get into a house. So the couple, there's less and less population growth because nobody can get into a bloody house with their partner where they can, do the wild thing and have kids. It's just, like you look at it and go, why would you have kids? They're bloody expensive. I can't afford it for a start, and I can't even buy my own place. So, that's why I say we've got to start raising wages quite considerably.
Yeah, well, I think there's a saying now that the 200,000 a year is the old 100,000 a year.
Yeah.
So people are on paper looking like they're earning really well, but after expenses and if you got a couple of kids, you've actually got bugger all to go on holiday at the end of the year. So,
well, in the old days, you see, we all had Medicare, and we all basically, not all of us, but only the really wealthy people sent their kids to private school. Right. Whereas these days, everyone's got their kids at private school. And part of it is because the public system has been so starved of money. And it's the same with hospitals, right? They're always struggling. So, you go, oh, well, I'll just take out private health cover, right? Because everybody's saying, well, you don't want to be bloody well stuck in the public system dying and going, oh, sorry, we haven't got the resources. Well, you have to prioritise and go, all right, well, I'll spend, whatever it is per month and be in private health cover.
Yeah.
It's a bit tricky.
It's a sticky situation. And speaking of sticky situations, China's net demand for new loans is the weakest in 19 years. So there's a decline in foreign money, and it's making life a bit difficult for President Xi.
Yeah, why do you think that is, Steve? Do you think it's anything to do with all the tariffs and the fact that, maybe businesses aren't making as much and there's the trickle down or what's...
It's again the model that they use, and this is why it's important to read about, if you're into this sort of thing, read about Japan or read books by a guy called Michael Pettis, right? Really, really good reads. It's an economic theory which is called mercantilism, and essentially what it is saying, we're a relatively poor country, but we got lots of people. Okay, let's get them into jobs by getting foreign capital in. So think of China in 2000, right? When they entered the WTO, the World Trade Organization, they said, okay, now we're part of the big group. So manufacturing exploded because they got 1.4 billion people, right? So they took the approach which was, we'll export to the world because we've got a really cheap labour source. Remember when it was... years ago, it was China is 8 cents a day, right? Well, in America, it was $8 an hour. Well, it was a no-brainer for Americans to go, let's get it built in China and then ship it over, right? And that's what happened. That's why they got hollowed out with the manufacturing, right? But that goes so far as a model to where you then have to say, we've got to get our own people, in this case the Chinese, to start consuming more. But Xi doesn't like consumption. He thinks that's a Western thing that makes you, sort of fat and lazy. Oh, you're just going to sit around and watch Netflix and, buy stuff, and that's lazy, right? And the communists are all for the, let's all dig in and build stuff and blah, blah, blah. So that's a real problem for China now because, as I said before, once the markets decline in terms of demand, that puts pressure on the Chinese. Right. And so when you go to a company and say, listen, Jacob, you're making EVs. I want you to borrow $5 million. And Jacob says, why? I can't even sell the EVs I got. Why would I start buying some, why would I start investing to sell more? And the Americans are saying, we're not having your EVs. And the Europeans are saying, we're not having your EVs either. So this is what's going on in China. Then the other step is the property market's now starting to fall. And so people are saying, well, I'm not going to buy property. So developers are saying, man, we got these 7,000 apartments we can't sell. You see what I mean?
And they've gone to the local governments now and said, well, you basically can buy them for next to nothing.
Yeah, and but the local governments have said the yield is like 0.5%. No thanks.
Crap, so I'm not going to do it. And they're just going to sit there. And it's a similar model to Japan, right? Where... They've basically carbon copied Japan, and now they're in the same situation.
Yep, and the same thing happened in Spain, right? They had a boom, they built heaps of property. Then once they said we've got too much property, nobody wants to borrow money. This is why I keep saying, once the borrowing starts falling, you got a real problem, right? Because the assets are sitting there where you're going, hang on, I'm negatively geared in this property, and I was banking on the capital gain. No one wants to buy your property now. So you're sitting there going, well, hang on, now I'm losing money on it.
So the question is, does the Chinese economy fall in 12 months or 30 years?
But, well, yes, it will be slow.
Yeah.
And the reason why is because they can't afford to have chaos. That's like total death for a social unrest for a communist system. That's when they get real problems. Right, so what they're going to have to do is, like Japan, they're going to have to bleed it slowly over 20 years until it becomes, quote, value again, where you go, okay, that property is worth 100,000, renminbi, right? But I'm not paying 300,000 renminbi. It's like, no way am I doing that. right?
What's a
You're out of control.
You want me to use yuan? That's a little bit easier to say, fellas.
All right. Okay.
Thursday.
That's just derailed
Yeah, I
me.
know.
Come on, push that button.
He's trouble.
Push that button. Oi, come on.
Okay, Thursday,
Jeez.
it's talk about recession. I'm seeing a lot more of this on Twitter and Facebook. Everyone's talking recession now. I know we've spoken about it on and off over the last couple of years anyway, but there was some commentary in here going that you would personally be surprised if US sees a recession.
Absolutely.
Well, I'm just wondering, with the Cape where it is, what's so surprising?
Well, this is why my
Stock
argument
market's not the
is
economy.
Well-
Back to the stock market, it's not the economy.
Yeah, but it's a good point, Tom, right? Because you equate the stock market with the economy. So what I'm saying is, if you look at the 1966 to 1982 period, in 66 the Cape was about 27, I think, and it took 66 to 82, right, 16 years to get the Cape back down to 5. But from 82 it went gangbusters, right? But at the moment we're at 35. So it's going to be a long way. I'm not saying it's going to 5, but what I'm saying is that when you look at it, as Jacob just alluded to, you've either got a stiff 50% crash, right? And then we go, all right, that was a hell of a ride. Let's get into the next one, right? Or alternatively, it's a slow bleed like Japan did over 30 years or like China will probably do. Now, that's less chaotic, but it's more painful because you get depressed economic growth for a long time. And that's what you've seen in Japan, right? The economic growth's been like 0.5%, 1%, falls into recession, 0.5%, 1%, because they've got to pay down all that private debt. And that's why I'm concerned about Australia, because we've got so much debt. But in the US, it's a little bit of a different story because they've got strong economic growth. They're having an investment boom. And so, again, what we talk about in the new normal is this transition period. And it doesn't make sense to a lot of people because they're working under the old paradigm, right? Which is, oh, well, the government spend a lot of money. Oh, that's bad, right? Government deficits are bad. Okay, well, that's it. They're going to crash the economy. Well, no, because the economy is growing at about 2.5% real, which is really good.
They're investing so much into the economy, into the country as well.
And this is the deglobalization bit again, right? They've got investment booms going on. They've got really cheap energy. The Biden government spent a lot of money on the Inflation Reduction Act, the CHIPS Act. So you can't look at it in the old way and go, oh, this is what's going to happen. But a lot of people who are not old and ancient like me don't know that because that's not the paradigm they've worked in, right? They've only ever seen the last 40 years of neoliberalism and free markets and privatisation and, this sort of stuff. And when that stops and changes, that's when it becomes confusing for a lot of people because they're going, well, hang on, it was supposed to do X. And say, yeah, but we're not in that world anymore. So you can't use that world to look at it. And that's what we're saying. That's why we're saying the new normal is different.
Okay. And what are your thoughts on Australia?
Well, we've got
recessions on the cards.
Well, maybe. I think, the argument is we're in a per capita recession, which is fair enough. Growth is awful. Inflation's really high. And Albo and Chalmers are going to spend, I think it's $28 billion next year. Now, that's sizable, right? That's about 1.2% of GDP. So that's all right. But but iron ore prices are falling. Right, so you got to just look at that sort of stuff. But the main thing you really should look at is government deficits. If government says we're going to spend 10% of GDP, you're going to go, wow, man, that's a lot of money, right? And that's what creates jobs. We're going to build bridges, we're going to build houses, we're going to build buildings, right? You get a boom. But if the government says, no, we're not doing anything, well, all you're doing is saying, okay, well, we're waiting for Jacob and Tom to spend. No, we're not spending, man. I got this big mortgage I got to pay off, right? So you don't get economic growth. And that's, as I say, that's what Japan had. And that's why I'm concerned about Australia because we've got, as you'll see in the next session, we talk about Australia's household disposable income is one of the highest in the world, top 2 or 3. Well, that's because all of the money is going to debt and we haven't got higher wages. And that's why we're just bubbling along where we're not really going anywhere. That's the whole thing. That's the whole way you want to have a look at it. Right.
Yeah.
But I can't see the US going into recession. But this morning I see, what's his name? Fed Chair Powell has basically said interest rate cuts are coming.
Yeah, they're predicting what? 8 rate cuts?
Yeah.
Well, the market's pricing
Yeah.
in 2% reduction.
Well, you know, that will just pour. That's like pouring petrol on the fire. Really, in one way, because the American household debt is quite low. It's quite modest. Well, you know what they're going to do, don't you? They're going to bloody leverage up again.
Yeah, 100%. So that, yeah.
Right, we're just going through
Household
this.
debt'll just go up.
Well, remember in the last coaching call I talked about boom and bust cycles. That's what they're doing. It's just bust, right? Now the boom, right? Everyone borrow again. We all gone bust, right? Let's borrow again, right? They just keep doing it over and over.
Just to go back a little bit, and people just have this misconception of the stock market is the economy and vice versa. With the US economy expected to continue to grow, do you think that that'll prop up the stock market?
Good question. The biggest correlation is with, and I think we did put a chart up probably a few weeks ago, maybe a few months ago, where if you have a look at the annual stock market returns and you look at annual GDP growth rates, there's a kind of correlation, right? But there are years where the economy doesn't do well and the stock market booms. Right, so a lot of it is on what's going to happen in the future. Excuse me. So I think what we're going to see is, as we've discussed before, which is the stock market probably won't go anywhere in a decade. Now, it may fall 50% and then it may rise 50% over the next decade, which means, you know, fast forward 2034, we're sitting here going, man, that's done nothing for 10 years. But my argument is because of high government deficits coming in the US, thanks to military spending, Social Security, Medicaid spending, that is going to sustain the economy, right? So as I said, I think a year ago, you're going to have a good job, you'll have wages, things will be fairly stable, but you won't be, you know, speculating like crazy. And that's why I say it's the new normal, because you'll feel more secure in a job, right? Because the demographics are, you guys are perfectly positioned, right? 30-year-old, old people like me are going, that's it, I'm out of the workforce, I'm going into a retirement village, and you guys are going, right, so you guys want me to build some stuff. Well, you're going to have to pay me a lot of money. We can't keep importing cheap labour because those countries are going to say, no, listen, Bob, you're not going to Australia, you stay here, we need you here. You think of Thailand, right, or Vietnam. They've got a manufacturing boom thanks to the Americans, right? So in those countries there would be going, man, we got a bright future, right? Why would they say, oh, I'm going to toddle off to Australia and work over there and, you know, not understand the language and try and study it and that's a long way from home and all that sort of stuff, when they say, hey, I've got a really good job here in a factory, just like China, right? Hey, got a good job in a factory here and life's looking up and things are great. Okay, I'm going to stay home.
That's a fair point.
You know, so I that's why I say we're transitioning out of the old world and you've got to get used to the new world, right? And it's going to be a different kind of place.
Well, on Friday, we've got a graphic here, and it just shows what happens after the Fed cuts rates, right? So everyone's wanting a rate cut.
Yep.
But if you look at history, 2000, Fed pivots, market falls 51%.
Caper 44.
Yep, 2007, Fed pivots, market drops 58%.
Caper 27.
Yep, 2019, Fed pivots, drops 35%.
Capered about 33.
But then goes up.
Yeah.
Within about 2 minutes.
Yep.
In 2019.
Yeah, in 2019.
Now, just think about it this way. Powell this morning, August whatever we're in, 23rd or 24th, Powell has said rate cuts are coming. Well, if you looked at that chart, you go, no, please don't cut rates. Because every time you cut rates, the stock market tanks, right? Why does it tank? It tanks because at the moment, when you raise interest rates, you are paying more money into the economy, right? You imagine, Tom, if you got $1 million, right? And I say, listen, Tom, I'll give you 5%. You go, cool. Okay. So I'm giving you 5%, right? And you're living off it or spending it, whatever, right? Then I come along and I say, hey, Tom, I'm going to give you 6%. You go, man, this is fantastic, right? Now, flip side it. If I say, Tom, actually, I'm not going to give you 5 anymore. I'm going to give you 4. You go, oh, okay. Now I've got less money, right? You're saying, oh, well, Steve used to give me $100,000 a year. Now he's only giving me 80. Oh, well, that's less money. So rate cuts take money out of the economy.
Yeah, but then people will just go speculate. They'll buy more property and push that up again.
Well, generally, that's one of the connections, right? And they argue that low rates are good for growth, but they're actually not. When you look at history, it says it's not good for growth. And the reason why is because exactly why you talked about it. Look at Australia. We've had low rates. We've had a property boom. We've got overvalued property and the economy's shit at 1%. Well, how does that work? Because property is an unproductive asset. Everybody's got debt.
It's, right? It's tying it up. You can't sell a bedroom.
Well,
spend it.
Yeah, but even though, Jacob, the point being, when you have a debt, you got to pay the debt you got to pay the income.
Yeah.
You got to pay the repayment from your income. Well, the bigger the repayment, the less disposable income. The less you're going to go to restaurants and pictures and buy stuff. Ipso facto, the less economic growth. Right? And that's the problem with debt.
I think you said before in the coffee shop, it's forced saving. Property is forced saving.
Yeah. It's not, people like to think they're investing. Well, yeah, kind of. It's really forced. I call it forced saving. It's not forced investing, right? Because if you go 30 years down the track and you've made 1%, well, you didn't really invest much, right? You don't get there and go, oh, mate, I made a bucket load. Now, caveat to all those blokes out there on Instagram who write to me and tell me, the fucking thing's doubled every 10 years, right? Yes, but it's not now, right? That's what I'm saying. The reason why I made money in property was because I bought at the right time, by luck, right? But also, too, where they go, oh, these boomers have made money. It's like, yeah, because we bought a property in 1980. Like we've had like bloody 45 years.
Yeah, we paid $50 for it.
Yeah. But that's why I'm saying, I'm not saying that it's a bad investment. I'm just saying if you buy now at 13.5 times income, well, it's a little bit different from when you bought it at 3 times income. And remember, for the last 40 years, we've had falling interest rates, right? But people have continued to pay off the mortgage at a higher rate rather than saying, oh, interest rates have dropped. I don't have to pay 200, now I'll pay 150. Well, people don't do that. They say, oh, well, we'll just keep paying 200. And they pay it off earlier.
Yeah.
That's great if the rates are falling, right? But to your point, what I'm putting there in that chart is saying, contrary to what intuition, rate cuts are good for the economy. It's like, no, it's not, right? And there's the history. Again, we always say to people, go and look at history because you get an idea about what's going on. Oh, what happened the last time Fed cut rates? Oh, what happened when they did it when the Cape was 35? Oh, okay.
No, I think it's super insightful because the standard thought process is that property always will just go up because it has for so long. So
well, it's the same. It's the same for stocks too.
Yeah.
People say, "Oh, stocks always go up," and it's like, well, yeah, but would you be happy if you said, "Oh, well, they always went up for 20 years, but I made 0.5%"? It's like, not really. Oh, well, they went up, right? That's why you mentioned before, Jacob. We talk about yield. What's the yield you're getting? I'm getting 0.5%. All right, best of luck. That's what you're going to get.
Keep your cash.
You're not going to, unless you get some crazy boom that you sell into, then you might make 7 or 8. But please don't expect it if the 10-year yield is at 0.5%, right?
Yeah. Well, we've got the next chart here, newly unproductive forces. So another snippet on China. And what's this showing, Steve? So state-directed investment in high-quality productive forces is leading to massive overproduction that will reverberate in global markets for manufactured goods.
Yeah, it's just what I'm saying about the car industry. The car industry is perfect, right? They can make cars for everybody in the world. Now that's changing. And if you look at, and I think I put it in next week's episode, but there's 50% of the EV makers are losing money. Well, sorry, you can't.
So you're saying that we'll get less. There'll be like 5 or 6 main players.
Yeah.
Everyone else are dispersed.
In 1920, don't hold me to it, 1920 odd or something like that, there were 2,000 car makers in the US, right? Or some ridiculous figure. Now there's 3, right? 3 American ones, GM, Ford and Chrysler, right? So in China, this is again the same thing. You're looking at EVs going, man, there's 100 companies making EV cars. Well, the market's good for about 6.
Yeah.
So there's 94 that are going to go belly up. If you're invested in them, you want to be really, really careful.
Yeah, this comes back to the durable competitive advantage.
Exactly,
stuff,
Tom.
right?
Yeah.
All right, so we're probably getting close to that point where we need to start wrapping up. The short story, again, it's just about China and our belief that China nears the tipping point for a combination of things we've already kind of touched on.
Yep.
Less foreign involvement, asset overvaluation, falling loan demand, less foreign capital, and then the geopolitical stuff with Iran and Russia.
Yep. There's some really, just let me say this, there's some really cheap stocks in China, but it's got to be a bit careful.
Yeah, I've played that game before with Russia.
With Russia.
Yeah, well,
It resulted in me not being able to sell them.
a
I
little,
bought them really cheap. I just
yeah, but a little
sell
bit
them.
different because China's probably not a war threat. But what I'm saying is it's more of a Japan threat where you look at it and go, man, it's on a PE of 5, but it stays on a PE of 5 for, 10 years.
Yeah.
And it's subsidised in an industry, all of that sort of stuff. It depends on exports. It's got heaps of government debt, but the numbers look really good. And then you find out they're lying. You've got to be a little bit more careful. And that's why I say we're in a new world. And you've got to just be a little bit more circumspect about some stuff.
Yeah, it's why asset allocation is important with China.
Absolutely. Now, just whiz to the chart of the week.
The chow.
The chow.
Have we got we've got one here. Look, there you go.
Oh, this was so interesting. In 1980, 29% of the S&P 500 were energy companies. Do you want to have a guess?
Well, the
what they are
weighting.
today?
No, the weighting as a percentage.
The weighting as a
Yeah,
percentage.
like the total value.
Yeah.
Yeah.
I would have a guess, but I can see the number, so it's 4%.
No, just guess without seeing the number.
It's 4% now.
Mr.
Is that
Mr.
right?
Big Opportunity, Mr. Big Opportunity there to look smart, buddy.
Dude.
Yeah, take a
Trust and
stab at it.
integrity.
Oh, I'd say 4 or 5. But what about EBITDA? Oh, probably greater than 10.
He's an honest man.
Touch over 10.
He's an honest man.
But just the point we made in the masterclass, energy's cheap. Go and look there. Thanks, folks.
Perfect.
Done.
All right.
Thanks,
See you next
everyone.
time.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.